Welcome back to the Williams Real Estate Channel. Today we are discussing key mistakes made by property investors. Be sure to not make these mistakes. They're quite common, and if you can avoid them, you'll save thousands and if not millions of dollars. So first one is thinking you can do it all yourself. Look, there's a stat by the ATO. Less than 1% of Australians have 6 or more investment properties. So it's not cut out for everyone, and rather than trying to reinvent the wheel, trial and error to see what works, what doesn't work, you might as well follow proven track records, proven systems, proven strategies that work. It's typical Australian culture trying to do everything yourself, but you got to spend money to make money, and you can save yourself thousands, if not millions of dollars, and lots of lost time and effort if you can find someone that you want to achieve what they've done, and if you resonate with them, and away you go. But don't try and reinvent the wheel. Number 2 is listen to family and friends. Look, I've made this mistake. I listened to, at the start, family saying, oh, don't buy in this area, which in hindsight, I wish I didn't listen, because if I just bought there, I would have made a lot more money and been a lot further ahead than I was today, and not listen to other people's opinions of what's good, bad, or indifferent, or what you should or shouldn't do. Because the reality is, if your friends and family haven't achieved what you're trying to do, then take their comments respectfully with a grain of salt, but the reality is they will only hold you back. If you're listening to people that haven't done what you want to achieve, there's no point of taking on their advice, as it'll only hold you back. And obviously, friends and family are trying to do the right thing by you, and protect you from making a wrong choice or wrong decision. But ultimately, if they haven't done what you're trying to achieve, there's no real point of listening or taking on board what they have when it comes to property investing. Number 3, saving for many years to try and buy a family home. This is a very common one. Millennials, people in their 20s and 30s and even 40s, still trying to slog it out to save a deposit to buy their dream place. You don't go and buy your dream car first. You don't go try and buy a Ferrari as your first car. So why try and buy something that you want to live in for the rest of your life? Because the reality is times have changed. It's no longer like it was in the 70s and 80s, where you could have got into a property with 2 or 3 years worth of savings. You have to save longer and longer, and the longer you save, inflation continues to erode your cash, your savings. The property market continues to run. The market does not wait for anyone, and you continue to get further and further behind. So these days you need to flip the script. Invest first, get in the market as soon as you can, hedge your wealth against inflation, grow your wealth, and you don't need big bucks to start. 40 grand, 50 grand cash, 200,000 borrowing capacity, you can get in. Get in, start buying investments, build on that, build a base, and then delay buying the family home, because the reality is, if you can buy something that you want to live in, ask yourself, is it something that you're going to want to live in for the rest of your life? No. If it's no, well then why use that as your investment vehicle? Because you might be getting into the wrong market, the wrong time, overpaying, paying a premium, costing you more money to keep it, hold it, run your numbers. If you can rent the same property for a third or up to a fifth, especially in Sydney, of the holding costs, then owning it, then rent it. And then once you can then go down the investment route and you change your mindset and you look to rent vest, which is the 4th mistake, on my list is people don't exploit rent vesting enough. If you go down the rent vesting route, you'll find that the banks will lend you 50 to 60% more than they would if you go and try and buy a family home. So you can buy 50 to 60% more property. You can diversify across multiple markets. You can collect rent, and then the banks want to continue to give you more money so you can keep snowballing and growing, you're building your wealth, and then delay buying the family home, and then in 10, 15 years time, once you've built your solid base, you'll be able to buy something that you would have never been able to achieve if you just saved and tried to go into a family home. But each to their own. That's my opinion. And you'll find that most property investors that have decent portfolios rent vested in their early stages while they acquired enough property to supplement their lifestyle, and then eventually buy the family home if you look to do so down the track. Number 5, not using LMI. So lender's mortgage insurance, I use it probably for the first 3 or 4 properties. Allows you to get in with a 5% deposit. Sure, you'll have to pay 2, 3, 4 grand, 5 grand for lender's mortgage insurance. They can tack it onto the loan rather than saving 20% deposit. You can use smaller deposits so you can buy more property quicker. After a while, once you get a bit of a roll on, the equity and cash out won't become your issue. Preserving your borrowing capacity will become your issue. I mean, over time, the market will move, and then you can then use 20% deposits once you get a bit of a roll on. But early on, LMI, why not? Risk is the lender's mortgage insurance covers the bank. It doesn't cover the borrower. So if the bank gets wobbly and they're looking to sell, they'll be more inclined to sell if you don't meet your repayments if they're covered by insurance. If they're not covered, then they'll probably be looking to work with you further. So they're things to think about and weigh up. But when you're starting off and you've got minimal cash reserves, it's definitely a powerful way to get into the market and buy multiple properties very, very quickly. Number 6, shopping around to get the best interest rate. Sure, having interest rates is nice, but it's not the be-all and end-all. I would rather pay 1 or 2% extra in interest, which I do. I've got the lowest interest rate around 6.2 and the highest is 8.8, because the banks will give you the money. You'll find you'll start with the big 4 banks, and then if you want to continue pushing the envelope, you can go to the second, third tier lenders and the non-bank lenders. They'll charge you an extra 1.5%, 2%, but they'll give you the money. If you can get that money put into the market and grow your wealth, and you can find an asset that can cash flow a 6, 7, 8% interest, then it's the cost of doing business. So I would rather get the money out of the bank, even if I'm paying an extra 1 or 2% interest, or even shop around to refinance to draw equity out and get more borrowing capacity if I have to trade it off with a higher interest rate. It's the cost of doing business. So if you shop around trying to get the lowest interest rate, you might hold yourself back in terms of how much capital you can obtain to continue to keep growing, and you might hold yourself back of how many properties you'll be able to purchase. Cross-collateralization of loans. So this is a common one. This is when a bank will try to, and they can be sneaky on it, which is why you should be across your mortgage papers and also work with a mortgage broker. But the banks want to try and bundle up all the loans. So for an example, you might have a property and then you might be applying for a new loan to get your second property. And what the banks can do is the loan can have 2 securities, so two properties on the one loan. So you might get an investment loan, and an example is, classic example is, you might refinance the family home or your first investment property to borrow more cash and get another loan to buy another property, and the loan, the banks put both properties on that same loan and crossing the security with that. You want to keep them all in silo, all separate, because if one property goes up in value, one property is stagnant or goes through a downturn, you have to revalue both in order to recycle and get your equity back out. So if they're separate, you can then tap into the property that has had the growth, rather than if you bundle it all up, it makes it harder to grow and continue to move forward. You can get out of it by refinancing to a different bank and then breaking it up. But just keep in mind, when you get the mortgage papers, look in the section where it says security, what is securitizing this loan, and it should only be the address for the property that you're buying and not a number of them. The banks won't tell you about it. They'll try and do it without you even realizing, because they like to keep control. So that's a common mistake. Number 8 is taking no from a bank. If a bank says no, then it's time to find a new bank. Or even if a mortgage broker says no, time to find a new mortgage broker. That goes for everything, really. If you ever get stuck, if it ever says, oh, you can't borrow or you can't do this, well, then it's time to find someone that can get you there and keep growing and moving you forward. Because there's always a way. There's a million ways to skin a cat. You might refinance with a different bank. You might have to sell something to raise cash, pay down debt. You might need to restructure your debts into a trust. There's many ways to skin a cat. And if it's all too hard for someone, it happened to me. I used multiple, just walked into the CBA banks at the start, got me to around 7 or 8 properties. By the end of just walking into the bank branch, I was saying I want the most experienced person in the building. You know, you get the most experienced lending specialist, but it becomes too hard basket for them. If they'd rather, the banks, you know, the people working in the banks would just rather write an easy loan for $1 million to someone who's buying one property, rather than having to go through a whole portfolio. So they said no. So then I had to find mortgage brokers that can continue to keep moving me forward. And then the same issue, you got too much debt, you can't borrow. And then I continued to move forward and found Shore Financial. So if you want to get connected with Shore Financial, reach out. I can connect you with a great mortgage broker that they can help you structure your debts properly within trusses and allow you to keep moving and growing forward. And it doesn't matter how big you are, they'll always be there to help you. So never take no for an answer. Paying off debt. So the idea is to continue to keep refinancing your property so you can continue to keep buying more property, and then over time the growth will continue to rise, the rents continue to rise, and inflation, property inflation, runs at 7 to 8% every year. In the booms, 20%, 25%. In the slowdowns, 2 or 3%. But on average, you can bank on 7 to 8% per year. So if the growth continues to grow 7, 8% a year, that same property inflation continues to devalue the debt. So $1 million worth of debt today, in 10 years' time, will be worth 150, 200 grand. So it's irrelevant paying it off, because inflation will erode it over time, and the gap between your equity and debt will continue to grow. So will your rents. And if you're refinancing to buy more property, you're only going to be drawing more equity and increasing your debt levels over time anyway. You can also tap into it to fund your lifestyle, which is what most property investors do. The money is in the refinance, getting your cash out, your capital back out to not only reinvest, but then also to fund your lifestyle, like using working capital in a business. So may take a bit to get your head around it, but over time, after a good 5, 6, 10 years of investing, you'll see the light, and it doesn't really make sense to pay down the debt when you're only going to refinance to draw it back out again, and the interest is just the cost of doing business. Next mistake is investors not claiming the interest for their investment property. So this is, can be a bit of a silly mistake, but all interest on investment debt is tax deductible, so you can claim it. It's just like running a business. It can get tricky, say if you're refinancing a family home to draw out equity, that portion that you're using for that on the family home, for example, to buy an investment is tax deductible, not the family home though. So make sure you've got a good accountant. Next mistake is not reviewing your position enough. So I'm always constantly reviewing my position every week, every month really. But if you buy a property or two and then you just set and forget, and you take the last conversation as gospel from your mortgage broker saying you can't borrow or what have you, and you don't review your position, you don't review your equity. Banking policies change all the time, especially with rates going up and down, around and around. They're always trying to find ways to lend to keep their loan books turning over. They want to do business. So if 6 months ago you couldn't do anything, look at your position and you probably can do something today. So always review your position, always review how well your properties are growing, what interest rate you're paying, how much equity you got, what your borrowing capacity is. And once you get capacity, put it into the market, because the market just continues to move on and doesn't wait for anyone. The Achilles heel for me, and it should be for everyone, is getting money out of the banks. As soon as I can get money out of the bank, either by refinance or borrowing capacity, I go buy another property. That's the Achilles heel. If you're not pushing the banks that hard and you got capacity, lazy capacity, if it's equity in a home or if it's borrowing capacity that you're not tapping into, if you're only got with the big 4 banks and you're not touching the second, third tier lenders, or you don't even have a trust opened up, you've got lost opportunity, lost capacity that you could be putting into the market, because your highest capacity will be during your working career between the age of 20 to 60. That's the sweet spot. And if you're sitting around saying, oh, I'll get around to next year or the year after or whatever, you're wasting time of your prime, because a career will last to your 60, and that's if you're good. Good luck trying to hold on to your corporate job or whatever you're doing after 60. The young people come up, they're cheaper, more motivated, more of a spring in their step. So you got to use that period to your full capacity rather than waiting and getting around to it down the track, because during your working career, that's when you can build your most wealth. So always push to use your full capacity. Next mistake is getting into commercial property too early. Now, I did a separate video on this, so you'll be able to see a full breakdown, but short story is there's lots of people looking to get into commercial property these days, and it's the typical behavior we see at this point of the cycle. We're 12 months away from peak market. We're due for the next land-driven downturn. Equivalent point of the cycle, 2006 or 1988, 1989, or in the late 60s, before the GFC in 2008, before the 91 recession we had to have in 1990, 91, before the 1972, 73 recession. So we're due for the next land-driven downturn, and this one's going to be a big one, because every second one's a big one, come 27, 28. So commercial property has shown in history it can lose 50% easy of the value in the downturns. And then it can go vacant for 2 to 4 years. So if you can't float it for 2 to 4 years with no tenant, so if you don't have a substantial foundation residential portfolio to support it or a shitload of cash in the bank, then you probably shouldn't buy it because it'll wipe you out. If you lose the tenant, and you bought the property now in the boom, the final stage of the boom, based off a cap rate of 5-6%, that's great if you've got a tenant. But what happens when the tenant vacates or the tenant goes broke and can't pay rent, and then it goes vacant? You got no income. So be cautious not to get into it too early. And there's lots of people out there pushing it these days, saying it's the be all and end all, it's the future. Well, let's see how it all pans out in the wash. The best time to buy commercial property is in the downturns vacant. You get it 50%, if not 60, 70% on discount. And then if you can fill the space and get it rented, then you can use the capitalization method of valuing it. You'll double your money, if not triple your money. You can then refinance, get your capital back out, or keep it for long term, or sell it on to the next person. But it's not a very wise idea to get into commercial property peak market based off a cap rate. Make sure that you're buying stuff for well under the replacement value. So how much does the land construction cost? You want to buy it for half of that. And if you're paying overs, well then, good luck to you. Lucky last, thinking one type of property only works and sticking to that type. So I'm all for every type of property, and everyone should be too, because every type of property has its time in the sun. As an example, the last recent years, 3 to 5 years, houses in the regions have took off. However, in the next 5 to 10 years, houses in the regions are not going to keep taking off. They're going to stagnate. Commercial property has had a good run recent years. But as we go through the land-driven downturn, commercial property, high-end real estate, new and off-the-plan stock gets hit the hardest. Between 30 to 50, 60% can correct. Entry-level stock, so units, villas, townhouses, houses, established stuff, tends to rise. The entry-level stock, sub 500 grand, well under replacement value, will rise if you've got strong yields and you're getting in the right markets in times of crisis, because the demand shifts to the affordable end. Sometimes houses run and then units stagnate for a number of years, and then houses top out, and then people see value in units and villas, and then they start to take off. So everything runs its own race as the cycle plays out, and everything works in synergy in a well-diversified portfolio across the whole country. So if you just stick to, say, houses, because houses supposedly have a block of land and they only have capital growth, it's bullshit. We were buying units, villas, townhouses for 150 grand, 160 grand in southeast Queensland 3 to 5 years ago. Now they're all worth 450 plus. So if units don't grow, then how the hell did they more than double in less than 5 years? So if you stick to houses, you can get stuck with finance because it's very lumpy. You want to throw in a couple of units like kindling on a fire, and then you want to get a couple of houses you can add second dwellings on or knock down and redevelop down the track. Then you want to get into duplexes, blocks of units, then ease your way into commercial by way of buying bigger blocks of units, so blocks of 6s, 10s, then maybe buy a boarding house, then look to buy a warehouse in the downturn vacant and try and fill it because you get it half price. Then shopping centres, and keep carrying on. But ease your way into commercial is how I'm going to do it and how I'll help people do it. And everything works well in a well-diversified portfolio. So the way I like to build portfolios for people these days is basically what I would do if I would to start again today. In hindsight, And the kids that I'm helping these days are doing way better than what I started when I was 24, and a couple of clients are younger than 22 and they're getting into their fourth and fifth property. The benefit of hindsight, benefit of working with people that have done it before. Starting off, units, villas, townhouses in metro markets, you get the growth, provided you're buying them at the right price, right time of the cycle, strong yield. Once you get a bit of growth out of them, because they'll run once the mainstream sees value, they just take off. Then you can tap the equity, move that out into the regions to buy houses on large parcels of land that have development upside, that you may want to build a granny flat, subdivide a second house, or build a flattened block of 2 or 3 townhouses. Then move on to duplexes, so 2 units on one site, then blocks of 3s, blocks of 4s, 6s, 10s, boarding houses, commercial property. And you may sneak in your family home as you grow your portfolio. But we specialise in building solid residential foundation portfolios, 10 in 10 years. And hopefully that makes sense to you, and hopefully I've saved you thousands, if not millions of dollars for making the wrong mistake. Until next time, thank you very much for watching.